Welcome to HouseLux Estate, your trusted guide for all things home and finance. We're here to empower you with practical, easy-to-understand insights into homeownership and finance. Today, we're tackling a topic that's relevant to everyone: surviving a financial crisis. Whether it's a personal financial downturn or a global economic recession, knowing how to navigate these tough times is crucial. So buckle up as we delve into the practical steps you can take to weather any financial storm. A financial crisis may seem like an intimidating term, but it's essential to understand what it means. So what is a financial crisis? In a nutshell, it's a situation where the value of financial institutions or assets drops rapidly. This could be caused by a variety of factors such as a sudden economic shock, a severe recession, or even a global pandemic. Imagine for a moment a game of dominoes. Each standing piece represents a financial institution. When one falls, it sets off a chain reaction, causing others to topple as well. This is similar to how a financial crisis occurs. When one bank or financial institution fails, it can lead to a domino effect, causing others to fail too. Now, what does this mean for individuals, particularly homeowners? When a financial crisis occurs, it can lead to job losses, reduced income, and a drop in house prices. This can make it challenging for homeowners to meet their mortgage repayments, potentially leading to foreclosure. But it's not all doom and gloom. Understanding a financial crisis can enable us to prepare. It's like knowing a storm is coming. We can't stop the storm, but we can batten down the hatches, secure the windows, and ensure we have enough supplies to weather it. Preparation is key. It includes having a solid financial plan, keeping an emergency fund, reducing unnecessary expenses, and diversifying income. These actions can create a buffer, protecting us from the worst effects of a financial crisis. Remember, a financial crisis doesn't have to spell disaster. It can be an opportunity to reassess our financial habits, make necessary changes, and emerge stronger. The importance of understanding a financial crisis cannot be overstated. It's like a roadmap, showing us the potential pitfalls and how to avoid them. It empowers us to take control of our financial future, ensuring we're not merely surviving but thriving, even in challenging times. Now that we understand the concept, we can explore how to effectively survive a financial crisis. One of the first lines of defense against a financial crisis is an emergency fund. Now you might be wondering, what's an emergency fund? Well, it's essentially a financial safety net. It's money that you've saved specifically for unexpected expenses or financial emergencies, like losing your job or facing a sudden health issue. It's not for planned expenses or luxury purchases. It's your parachute when you're free-falling in the unpredictable sky of life. So how much should an emergency fund ideally contain? Well, most financial experts would say it should cover between 3 to 6 months of your essential living expenses. This includes rent or mortgage, food, utilities, transportation, healthcare, and any other necessary costs. It's not about maintaining your current lifestyle, but ensuring that you can meet your basic needs. Building an emergency fund might seem like a daunting task, especially if you're starting from scratch, but don't worry, it's all about taking small, consistent steps. Start by setting a monthly savings goal. It could be as small as $10 or as large as $500 depending on your income and expenses. The key is to make it realistic and achievable. Next, consider automating your savings. This means setting up a regular transfer from your checking account to your savings account. It's a set-it-and-forget-it approach that can make saving money much easier. Another tip is to treat your savings like a bill. Just as you wouldn't skip paying your rent or utilities, don't skip adding to your emergency fund. Even if you can only contribute a small amount, every little bit helps. Lastly, consider keeping your emergency fund in a high-yield savings account. This type of account typically offers a higher interest rate than a regular savings account, which can help your money grow over time. Remember, an emergency fund isn't built in a day. It takes time, patience, and discipline. But the peace of mind it provides is well worth the effort. Having an emergency fund can give you peace of mind and a safety net when you need it most. Cutting back on expenses is another crucial step in surviving a financial crisis. In times of financial uncertainty, it's imperative to take a good, hard look at our spending habits. It's time to identify the necessary from the frivolous and make some tough decisions. One of the most effective ways to reduce expenses is downsizing. This could mean moving to a smaller home or even selling a second vehicle. When considering downsizing, it's important to weigh the cost and benefits. Sure, a smaller home might mean less space, but it also means lower mortgage payments, reduced utility bills, and less upkeep. Next, let's talk about eliminating unnecessary spending. This may seem obvious, but you'd be surprised at how much we spend on things we don't really need. It's those small, daily purchases that can add up over time. The $5 coffees, the premium cable packages, and the spontaneous online shopping sprees. Cutting back on these can free up a substantial amount of money over time. And then, there's negotiating bills. Many of us accept our monthly bills as a fixed cost, but you'd be surprised at how many companies are willing to negotiate. This could be your cable provider, your insurance company, or even your credit card company. It doesn't hurt to make a call and ask if they can offer a better rate. Sometimes the savings can be significant. In fact, there's a saying that goes, "A penny saved is a penny earned." But in a financial crisis, every dollar saved is not just a dollar earned, it's a lifeline. It's a buffer between you and financial ruin. It's a step towards financial stability, so start today. Look at your expenses, identify what you can cut back on or eliminate, and start saving. It may seem like a daunting task, but remember, every little bit helps. Remember, every dollar saved is a dollar earned. In times of financial crisis, having multiple income streams can be a lifesaver. The idea of diversifying income streams isn't just about having a side job or two. It's about creating multiple sources of income that can supplement your primary paycheck, and more importantly, continue to bring in revenue even when times are tough. One way to diversify your income stream is through passive income. This is money you earn with little to no daily effort, like from rental properties or investments. Imagine owning a house and renting it out. The rent you receive each month is a form of passive income. Or perhaps you've invested in stocks or mutual funds. The dividends you receive are also a form of passive income. You might be thinking, I don't have the money to buy property or invest in stocks. That's okay. There are other ways to generate passive income. For instance, you could write a book, create an online course, or start a blog. Once these are set up, they can generate income for years with minimal maintenance. Another way to diversify your income is through side hustles. These are small, often flexible jobs that you can do in your spare time. It could be anything from selling handmade crafts online, freelance writing, tutoring, or even driving for a ride-sharing service. The key is to find something you enjoy and are good at that also has the potential to bring in some extra cash. But why diversify? Why not just focus on one job and do it well? The answer is simple. It's all about risk management. By relying on a single source of income, you put yourself at financial risk if that source is disrupted, but by having multiple income streams, you spread the risk. If one stream dries up, you have others to fall back on. In conclusion, diversifying your income is not just about making more money. It's about creating a safety net, a financial buffer that can help you weather the storms of economic uncertainty. By diversifying your income, you create a financial buffer and increase your resilience during tough times. Surviving a financial crisis is not just about weathering the storm, but coming out stronger on the other side. And we've covered a lot of ground today in helping you do just that. Let's take a moment to recap. We began by understanding a financial crisis, a challenging period marked by economic decline and uncertainty. We learned that these crises are not always predictable, but with the right knowledge, we can prepare for the unexpected. Next, we discussed the importance of building an emergency fund. This fund acts as a safety net during financial downturns and can mean the difference between sinking or swimming when the waters get choppy. We then moved on to the topic of reducing expenses. We all know that saving money is easier said than done, but with a few tweaks and some discipline, we can make significant savings that will serve us well in times of crisis. Lastly, we touched on diversifying income streams. This strategy ensures that if one source of income takes a hit, we have others to fall back on. So there you have it. Understanding, preparing, saving, and diversifying are your 4 cornerstones to surviving any financial crisis. Thank you for watching. Don't forget to subscribe to House Lux Estate for more practical and educational content on home and finance. Remember, with the right preparation, you can survive any financial crisis.